Hello, everyone. Welcome to Awaken Your Freedom Show. Please subscribe to support our growing community. Today, we're doing a deep dive into a really fascinating approach to investing. It's one that, well, it challenges a lot of common assumptions. And surprisingly, it promises something called the most boring way to get rich that works like magic. Sounds kind of weird, right? We're digging into the core ideas of investment legend John C. Bogle, mostly from his big book, The Little Book of Common Sense Investing. You almost picture Bogle like holding up a mirror to you and saying, look, the biggest threat to your investment success, it's staring right back at you. His point was, most people don't fail because the market's too complicated or anything. They fail because they just get in their own way, chasing hot tips, panicking over headlines, always trying to beat the market.
Right, trying to outsmart it. And Bogle's common sense idea was so radical, really,
Mm-hmm.
especially compared to what Wall Street is constantly pushing. His core message, it sounds simple, almost too simple, but it's powerful. Don't try to beat the market, just own it. So this deep dive, we're going to unpack what that actually means for you, the individual investor, and why maybe this boring way, why it's actually so effective. It basically throws out the idea that you need some secret genius-level knowledge to build wealth.
Okay, yeah, let's break that down. Bogle's main point, his central truth, is something we kind of know but maybe forget. Over the long haul, the stock market tends to go up. Historically, in the U.S. anyway, it's been around, 9 or 10% a year on average?
Roughly, yeah, that's the long-term trend.
So, okay, if the market is this giant wealth machine, why does the average person investing in it actually make less than that? Often a lot less. It keeps coming back to that mirror Bogle mentioned, doesn't it? We mess with it too much. We react. We chase whatever's hot now. We jump in late and then bail out when things look scary, usually at the worst possible time.
Exactly. It's like we can't resist fiddling with the controls. So Bogle's solution is designed to be, well, boring, yeah, but it works. Step one, buy a low-cost index fund, one that basically owns the whole market or a huge chunk of it. Think of it like owning a tiny slice of, almost every big company out there.
A piece of the whole economic engine.
Right. Then, step two, keep adding money regularly, consistently. Don't try to time it, just keep adding. And then, this is the kicker, step three, do nothing. Just sit tight, let it ride.
It's about working with the market's long-term upward trend, not fighting it.
Precisely.
And the real-world examples are pretty powerful here. Like, imagine you bought the Vanguard 500 index fund, say, way back in 1990, and you actually followed Bogle's advice. You never touched it.
Okay.
You'd have lived through some crazy stuff, right? The dot-com bubble bursting, the huge 2008 financial crisis, even the COVID crash and recovery.
Yeah, some serious roller coasters.
But despite all that chaos, you'd have multiplied your money many, many times over. The ride might have been bumpy, sure, but the end result, pretty great.
Now, think about the active traders during that same period. The ones constantly jumping in, jumping out, trying to guess the tops and bottoms. They pay taxes on gains. They paid fees on every trade.
Transaction costs, yeah.
And the vast majority, they ended up losing to the market they were working so hard to beat, which kind of begs the question, why do we feel this need to complicate things?
That's a perfect lead-in to Bogle's next big point, costs. This is core principle number 2, costs matter way more than you probably think. Bogle was all about the math, but not like fancy Wall Street math. Simple arithmetic, the kind that shows how fees just kill your returns.
Oh, it's absolutely shocking when you see the numbers. He showed that if you pay, say, 2% in fees every year, over a long time, like 40 years, you could lose something like 2/3 of your potential returns just to those fees.
2/3. That sounds like it can't be right, but it is.
It's not a typo. Those fees come off the top, year after year, before your money really gets to grow. And that smaller base compounding over decades, it makes a massive difference downwards. Compounding is powerful, but fees make it work against you, quietly just eating away at your future wealth.
Okay, let's make it concrete. 2 friends, right? Each invest $10,000. Same time, 40 years. Let's say the market gives them both 7% a year before fees. Friend 1 uses a low-cost index fund, maybe paying 0.05%. Tiny fee.
Okay, super low.
Friend 2 uses a typical high-fee active mutual fund paying that 2% we talked about.
Right.
After 40 years, the low-cost friend ends up with roughly $149,000 more.
Wow.
Almost double the final note, just because of fees. Same market, same starting cash, same time, only difference, cost.
That really drives home Bogle's rule, doesn't it? Own the market at the lowest possible cost.
Yeah.
And never pay someone extra just so they can underperform for you.
Yeah, why pay more to get less?
It means you got to be really vigilant about every single 1/10% in fees. Because over your lifetime, those tiny amounts add up to serious money.
So, okay, the market generally goes up, keep costs super low. That leads right into his point about trying to guess the market's next move. Principle 3. Time in the market beats timing the market. Bogle was adamant about this. He called market timing a fool's errand. He basically said nobody, not analysts, not hedge funds, not those guys they call geniuses, nobody can consistently predict short-term market swings.
And the data just backs him up completely. It's pretty brutal, actually. Over like 15 years, something crazy. Like 92% of active fund managers fail to even match their benchmark index.
92%. So they're not even beating the average, let alone justifying their higher fees.
Exactly. And even the few that do win in one period, they often turn into losers in the next. It shows how much luck is involved. Not repeatable skill. It's really hard to do consistently.
And the cost of trying to time it and getting it wrong is huge. There's this stat. If you just miss the 10 best days in the stock market over 20 years, your total return could get cut literally in half.
Cut in half, just by missing 10 specific days out of thousands.
Yeah, it's staggering when you think about it.
And here's the really critical part. Those best days, they often happen right after the absolute worst days, which is exactly when most people are terrified and have already sold or are too scared to jump back in.
Right when fear is highest.
Yeah. So how do you, the investor, fight that basic human instinct to run away right when you probably should be staying put or even adding more?
Which is a perfect setup for Bogle's famous saying, our fourth principle. It's almost like investment zen. He said, don't look for the needle in the haystack, just buy the haystack.
I love that line. And what he means is stop gambling. Stop trying to guess which one stock is going to be the next huge winner, the next Apple or Google or whatever. Instead, just own all of them or a big representative slice through a broad index fund.
Buy the whole haystack.
Exactly. The winners inside that fund. They'll naturally grow and become a bigger piece of it. The losers, they just kind of fade away. And you don't waste any time or money or emotional energy trying to pick winners and losers. It's incredibly efficient.
Yeah, think about it. Back in, say, 2000, if you tried to pick the next Amazon, good luck. Most companies flame out.
Right. The odds are massively against you picking the one big winner.
But if you just owned the S&P 500 index back then, you already owned Amazon and Apple and Netflix and Google before they became these giants.
You owned the winners without even having to know they were the winners yet.
You didn't need a crystal ball. You just needed broad ownership.
That's the power of owning the haystack.
Okay, but now we get to the really hard part. The part where most people, even if they have the right strategy on paper, actually stumble. Principle 5. Stay the course even when it hurts. This is about when the market takes a big dive. 20%, 30%, sometimes more. That fear kicks in hard.
Oh, yeah. It's primal. Your gut is screaming, get out, sell, protect what's left. And Bogle's advice here sounds so simple, but man, is it hard to follow in the moment. Sit tight. Just stay put. History shows the market always recovers if you give it enough time. But our emotions, are hardwiring to avoid pain right now. It totally betrays our long-term goals.
It's a huge psychological battle.
Absolutely.
Think back to, March 2009. We were at the absolute bottom after the financial crisis. The world felt like it was ending, financially speaking.
Total panic in the air.
People who sold then, who gave in to the fear, they locked in huge losses and missed one of the biggest, longest bull markets in history that started right after. But the people who just held on, or maybe even gritted their teeth and added money when things looked bleakest, they saw their wealth explode in the following decade. Doubled, tripled, quadrupled. It was incredible just by staying put.
It really shows the power of patience over panic, which is why Bogle used that analogy of planting an oak tree.
Right, I remember that one.
Dig it up every few months to see if the roots are growing.
Right.
You plant it, you water it, that's like your regular contributions, and then you let time and, economic growth do their thing. You trust the process. You trust that fundamental engine of capitalism will keep working over the long term. It's about letting go of control in the short term.
So when you pull all these ideas together, some fresh insights kind of jump out, don't they? First, like you said, boredom is actually your friend here, maybe even your secret weapon. The less exciting your investment strategy feels day to day, probably the more money you're making long term. It's such a paradox.
Totally. Finance thrives on excitement, but your portfolio often thrives on calm.
Second, real wealth isn't built by being some kind of market genius or having secret info. It's built by discipline. Plain old discipline. You don't have to outsmart Wall Street. You just have to outlast its noise and your own impulses.
Outlast, not outsmart. Good way to put it.
Third, maybe think of the market less like an opponent you wrestle with and more like, I don't know, a powerful business partner. Let it do the heavy lifting for you. Don't fight it.
Let it work for you.
And maybe the biggest one, your worst enemy isn't a crash. It's not a recession. It's probably your own emotions getting the better of you.
Yeah, that reaction impulse.
And finally, just remember compounding. It's quiet. It's relentless. But every single day you stay invested, it's back there working its magic for you, building bit by bit.
It's true. And Bogle's whole strategy, it's so simple, so common sense, that it almost feels wrong, doesn't it? Because we're constantly told wealth building has to be complex, that you need special access or secret formulas.
Right.
But really, if you strip away all that noise, all the hype, all the emotional triggers, it boils down to these fundamentals. Keep your costs incredibly low. Own everything broadly. And have the patience, the sheer nerve to stick with it.
So, wrapping this up for you, the listener, well, what's the bottom line? Building real wealth through investing, Bogle style, it takes patience. It takes a ruthless focus on minimizing costs. It means broad diversification, owning that haystack. And maybe the hardest part, having the courage, the discipline to do nothing when everyone else is losing their minds.
Resist the urge to react. Trust the long game.
Yeah.
And think about this. If you actually follow this common sense path, you're not just likely to end up with more money. You'll probably keep your sanity too. And this crazy world of constant financial noise and fear-mongering, that peace of mind, that's truly priceless, isn't it?
Couldn't agree more. To close, please don't forget to subscribe on your favorite platform, YouTube, Apple Podcasts, Amazon Music, or Spotify to stay sharp and never miss a drop of knowledge that could change your financial life. Thank you.